Joining us now is Wedbush analyst David Chiaverini to set up this report. David, great to have you here. What are we most going to be looking for here? First of all, the stock up perhaps just because nobody's anticipating any unexpected blowups. Of course, we did have a lot of other regionals report, and so far, not a lot of signs of intensifying stress.
Yeah, so we are cautious on the name, but I would say that bulls are expecting results to be less bad than feared. Now, we're expecting deposits could be down as much as $75 billion. On a GAAP basis, consensus is calling for about $40 billion. And what I think is also driving the stock here today is we saw another bank that was kind of teetering after SVB went down. Western Alliance did rally hard after their results were better than feared, and the bulls on FRC are hoping for a repeat here. So that's what I think is really propelling the stock up today.
And bigger picture, I mean, we talk about the stock being up where it is. This was a $140 stock a couple of months ago, right? So it's not as if it really has changed the overall assessment by the market of what this actual business is going to be worth long term. But where does this leave the bank? Do they have enough liquidity for now? Do you feel as if they can sort of limp along without necessarily needing to raise more capital? The big unrealized losses clearly remain the overhang.
Yeah, and you hit the nail on the head. They do have enough liquidity to get through. And as long as they don't realize the unrealized losses, then they have enough capital to maintain their regulatory capital ratios. So the company does have some runway here to survive. Now, the issue is at what earnings power will the company be running at? Because when we look at their loan portfolio, it's yielding as of the fourth quarter 3.5%. On their website, they're offering CDs close to 5%. So that's going to lead to, based on their current portfolio, a negative spread, but at best, a very narrow spread for any new loans that they're making. And then to add on to that, the company has a junk rating from S&P and Moody's. So that's going to put additional funding pressure going forward. So they have a lot of wood to chop in the near term, but that's what investors who are looking at the stock here, they're looking at the tangible book value on a GAAP basis being $74. Even if they do run at EPS losses for a number of years, as long as that TBV on a GAAP basis stays, elevated relative to where the stock is trading, that's what's giving the bulls some strength here.
Yeah, I mean, it's a tough bull case to say that tangible book value won't crash that quickly, but I guess that is the situation they're in. What about across your coverage universe? Is the market in general correct in essentially believing that most of the impact has been recognized in the handful of institutions that have really suffered, or do you really think there are other shoes to drop or a more broad credit and profit crunch to come?
Yeah, the acute stress and the panic, I think, is behind us. Looking at all of the banks that reported last week, generally the theme was less bad than feared. Now, with that said, challenges remain for the group. Deposit competition is intensifying. Loan growth guidance was reduced. Net interest income, net interest margin guidance, that was lowered. Credit quality is a very big concern here. And in the most recent quarter, credit quality, just fine. But when we look out 12 to 18 months, and there's been a lot of discussion around commercial real estate and office properties, that's going to come home to roost over the next 12 to 18 months. And then on the capital front, people are worried about regulatory capital coming down and potentially banks needing to raise more capital as the regulators put more stringent standards in place for them. So a lot to be concerned about with the banks, but I think the near-term acute panic is behind us.